Welcome to the 42nd episode of Startup Strides. Today, my guest is Mr. Peter Bruce Clark. He's the founder and general partner of Kalytix Ventures, what I would describe as an impact investor. But Mr. Clark has his thoughts and opinions, which we'll discuss as we delve into the episode. But really excited about the episode. I feel like you have very cool insights and very unique perspectives. But I guess before we start with the questions and going into details, going through your LinkedIn, you kind of like a resume, you have a very impressive and extensive background. And I feel like it would be very hard for me to just do justice in a few words, few sentences. So if you don't mind, I would love to hear your story in your own words. I guess, what led you to the world of venture capital, and I guess what early experiences shaped you the way you operate as an investor today?
And I said a profound question about what drives me and why do I exist? Yeah, so it's a long and winding story, but I think to kick it off in a shorter kind of version of it, I think I have always grown up around the concepts of sustainability and long-term investment in climate change, as well as social injustice. So that was in my household really from when I was young, and I'm an only child as well. So your parents, they just talk to you like you're an adult, as healthy or unhealthy that may be. So quite aware of all of the challenges that we face. So, for me growing up, it was really trying to understand how can I do something in the face of a lot of grand challenges that I felt that, were kind of emerging in terms of our consciousness. And I didn't particularly have a solution. I was actually quite morose and quite depressed growing up. And all of that sort of idea of how could I have efficacy led me to studying English literature and critical theory for my undergraduate and immersing myself in a lot of philosophy as well as literature, which really paint pictures of worlds and are almost like time capsules, as it were. I kind of realized in a lot of my reading that the economy structures a lot of our reality, and who has what also structures a lot of what we experience, both objectively and subjectively. And then I ended up doing an MBA in business administration because everyone wanted to shove me in HR. Essentially, what was quite interesting in that work was looking at the history of financial markets and the evolution of financial product creation, but also how that impacted and the growth of interconnectedness between financial markets with the Asian financial crisis and the global financial crisis and things like that. And I suddenly was like, wow, capital and flows of capital really determine the reality that we've got. And I really want to be where the levers are because, as much as some of my early internships, and I actually worked from a very young age in macro advisory research groups. So Oxford Analytica, Oxford Economics, PwC, Mercer, you name it, I was shoehorned into it. And, what I find quite interesting is all the clients we had were big oil and gas companies, big insurers and things like that. It's surely we can channel money in towards projects that potentially make things just a bit better economically, environmentally, socially for others. And if it is such a structuring force, I'm sure projects exist out there. And I think that's when I really cottoned on to, I'd say my late teens really cottoned on to this idea of impact investing. And to your point, I don't consider myself an impact investor per se, but I do like many tenets of kind of how people invest with that kind of lens. I'd say my big break was going to Stanford after I'd done my MBA. I'd actually helped build a research house about sovereign wealth funds for Euromoney, which is owned by institutional investor. And there, what was so interesting about sovereign wealth funds, and I actually have a paper in the Oxford Handbook of sovereign wealth funds about strategic funds. So funds that have double or triple bottom line return expectations. So you can think of this in terms of Temasek or Khazanah or any of the national funds. I know you're from Azerbaijan. So, I know you've got an oil fund as well, right? And that was another really interesting data point about investors who care not just about the returns, but also planning over many years for the evolution of a nation state. And I think that's like incredible work. And I still think it's incredible work that these institutions do. And so my big break with Stanford is I basically got approached by a man called Dr. Ashby Monk, who's at the Global Project Center. He's sort of like an international guru for institutional investment, but also the engineering of finance. So his unit is located in the Department of Engineering on the Stanford campus, but it's a very conceptual unit. And it's more, even though it's got engineers and engineering researchers, it also have people who are like myself, who are slightly nonlinear and really want to have interesting conversations. And he proposed setting up a research project working with two different family offices. One is a very prolific billion-dollar family office out of Chicago to do research around how you would develop a vehicle to deliver both impact and returns. It was unstructured research, so it wasn't necessarily about venture capital. And what was so incredible about it is I basically had the latitude to go around very interesting networks of people who I otherwise wouldn't have had any access to, and have really interesting conversations, from private equity, real asset investors, sovereign funds, to then these people called venture capitalists who I had never known about or met before. I think the first venture capitalist I ever met in my life was James Weiss from Boulderton when I was a tadpole. And I always remember going to like his housewarming, being like, how do you have this house? And what do you do? Kind of thing. Like, I'm a venture capitalist, and I kind of push that to the back of my mind. So anyway, through this research, I realized that in order to generate impact and high returns, we really had to get presuppositions and assumptions right. And that's partly to do with my philosophy background. So I really went on a kind of wild egg hunt to try and figure out what were the real tenets to designing an impact fund, and how could you ensure that it is materializing what you want to deliver through the strategy. And it made me meet all sorts of people, some of like the luminary venture capitalists in Silicon Valley, people from PayPal, Square, all of that sort of thing. Like, I was very, very lucky. And I was based in San Francisco and San Mateo, so I got to go back and forth. And a lady who I met during that time of doing that research was a lady called Sarah Cohn, who's the managing partner and GP of Social Impact Capital. But we really didn't connect until later. And so I went through the cycle of then, after doing that research, which has actually been published as part of a group paper, which is probably one of the most mentioned papers in impact investing in terms of typology. So after going through that like gamut of experiences, I then tried my hand at entrepreneurship and in venture capital. Tried to build a machine learning focused fund when I was 24. Had amazing advisors like Luke Nozick and Sean McGuire from Sequoia and all of these people. But we had very limited track records. So it totally collapsed, unfortunately, which was such a shame. But it was very, very interesting as a learning experience. And then I went to a series of other different startups. So I'd say I ended up working with the founder of Coin, and Coin was basically the pre-touch pay with your iPhone. So you would load a card with a series of different cards. It got sold to Fitbit, and he had actually a wealth management firm, which was kind of trying to enable institutions to have really granular holds of their portfolios and to make decisions in really interesting and sophisticated ways. So I was really excited about that from an impact perspective, because I thought, well, if you could give a pension fund the ability to do really challenging types of investments, but also like the infrastructure around them to be able to do it directly, in the end, my belief is you would make more money for your nurses or teachers or whoever were the underlying beneficiaries. So I was the head of business development there. I actually worked with a number of sovereign wealth funds, including like the Irish Sovereign Wealth Fund. So again, really looking at impact. And then it got acquired by Adapar. And Adapar is basically a unicorn as well. It's backed by 8VC, started by Joe Lonsdale. And I would say that was in around 2017. And in 2017, I also then had reconnected with Sarah Cohn. She'd actually been working on a prototype fund and had been performing quite well. So that was quite exciting. And I always really liked talking with her, because I felt like her belief system around impact investing was very closely aligned with mine. I thought she was saying very sensible, very intuitive, and common sense things. I think sometimes in some of these sort of fields of investing where there's a lot of academic literature, you can like lose sight of the trees. So reconnected with her. She was curious about what I was up to, and she offered to potentially hire me when the fund launched. It was quite funny. We were actually in Miami at the same time when we were having this conversation, and she mentioned all the people who could be involved and who was really interesting. And I basically said that I could join immediately. And she was like really taken aback. It's like, well, what would you do? And it's like, well, here are all my past experiences. I'm a generalist, really good at strategy and just executing things really within conditions where there's a lot of uncertainty. I quite like doing that. And so I joined as chief of staff and basically went from managing a really short amount of money or a really small amount of pot of money to then launching the first fund, raised about 45 million. I led the financing function and all of the fundraising for that. But I also got the opportunity to learn venture capital from her and do really different sorts of investing. So that was really formative for me. At the same time, I was allowed, because it was structured as a solo GP fund, to do my own investments, provided that I brought the deals to the firm and that SIC had like kind of the first look. And so I also built up an angel portfolio, and I continued to do that and continue to do that today. And also my family invested in the fund as well. So we also have a couple of allocations to fund managers. Yeah, and so that was sort of my big baptism of fire, I guess, in impact investing. And I did that for 6 years and then spun out a couple of years ago in 2023 to work on my own portfolio.
I mean, I was being very honest when I said I couldn't do really justice to your impressive background. And there's so many questions that are coming to my head right now, but I don't want to diverge too much. So one thing I'm curious about, because at the very beginning, I kind of hesitated to call you like an impact investor, because we had some conversations beforehand, and I know you have some thoughts about that. Because and the reason I'm hesitating is because you do emphasize impact and resilience in your philosophy, in your kind of approach, but the term itself, you're not very, like, I guess you're not very, you haven't warmed up to, which that's one thing I'm curious about. And also, I'm curious about how you think of impact, sort of like as a mental model or metric or framework within VC space. Like, how do you measure it and how do you approach it? And what are the most common misconceptions?
Yeah, I think my like reticence to wave a massive flag around impact investing, I'm kind of two minds about it, and I'm often kind of ambivalent about it because, yes, truthfully, like I want to wake up every day and look in the mirror and be like, oh, I'm investing in things that actually matter, that I care about. That's really how I operate. I'm just a venture capitalist that cares about what I'm investing in and how that impacts how we live. That's simple, right? I think it's also a politicized term. I think that part of some of the challenges we've got in global finance right now are like these ideological battles around terms and kind of what they mean. Like, for instance, with sustainability, sure, sustainability is about the environment or social circumstances in which people find themselves and making sure that we like accommodate for that. But it also is another word for hyper efficiency in business efficiency and operations. So, it's interesting to look at what words people use and kind of what they mean by that. And I also just don't want to alienate others as well. Like, I think everyone should be able to invest in things that they really care about, that they think matter. And I really don't want to politicize that per se, if that makes sense.
I totally understand it. I guess when you think of what you said, like in terms of the way you measure impact, is that you invest in companies that you think are just going to do good for the planet. For that, is that how you look at it?
My general, I mean, obviously it's a bit more granular than that, but
Uh,
I mean, broadly, yeah, like, planetary health, human health, they're inextricably linked and we're interdependent as much as, the world would like to tell us that we're all a bunch of individuals. So, my general view is that I'm excited by companies that are tackling statistically significant grand challenges. So environmental challenges or social challenges that are either regional or global in nature. And they're doing that through either breakthrough technologies, which I would say are more towards like the survival aspect of my investment sort of approach, to technologies that I would say are more nudge or shove technologies, which I would describe as more like adaptation or resiliency. It's interesting, more recently, people are talking about resiliency and adaptation in real asset investing, but I was talking about this about 10 years ago. So it's really interesting to now see different sorts of asset classes considering how we're all networked together in this big glob of a planet. So I'd say that's how I approach things. It's early stage. I'm doing pre-seed to Series A typically. I really don't mind taking risk. I think the job of a venture capitalist is to take risk. So, for me, I'm really excited about big ideas, but also very practical ideas. So it doesn't necessarily have to be like, let's rip up the playbook entirely. It can be some technologies that have essentially like a massive efficiency gain, whether that's price, speed, or other variables. So I'm always looking for something that's like 10 to 100 times better than what's out there.
One thing I'm curious about is, and I know you have some thoughts about it too, and maybe you can take a look at it, kind of approach it from two angles. One as traditional VC and one as like impact VC, more specifically. I feel like there's some structural kind of flaws and kind of misaligned incentives sometimes that really, I guess, prevent like sort of like meaningful long-term impact or sustainable kind of impact. Do you think there's some structural flaws like that? What's your thoughts on that?
And what?
I guess I'm just curious about your opinions. Do you like, because and I don't know how you want to tackle it. And I don't know how you want to approach it, but I'm just curious. Do you think, for example, the way kind of like the VC business model is designed structurally prevents from kind of looking at things with more like the long term kind of impactful, sustainable innovation way?
I don't think that's necessarily true today. I think it maybe was in the past, but there are lots of VCs now talking about how VC may need to change to accommodate different sorts of technologies and the time horizons that they require. Like, for instance, I was at an event for London Climate Week put on by Climate First at Waddesdon Manor. And a lot of the discussion there was saying, okay, well, a 10-year time horizon actually doesn't quite work for climate tech investing. It's actually more like 13 to 15 years. So there is active conversation about what that fund structure or timeline should look like. And frankly, venture and private equity firms hypothetically are designed for long-term investing because they're quite illiquid. Of course, you've got the rise of the secondary market now, which is, I think, a net benefit as well in terms of allowing proof points for fund managers, because obviously like there's meant to be an illiquidity premium for investing over a long-term time horizon. You're hopefully the Nasdaq right over a 10-year period. So I think the challenge is there's no perfect asset class, right? And venture is so interesting because it's only one of very few asset classes that's kind of in the reality creation business, because you're funding things from basically nothing into something. Of course, there are different sorts of incentives that are slightly perverse that could be adjusted, usually around compensation or like bonuses to do with what you've actually produced. Some Scandinavian funds are really smart on this as well. Like Norsken has an incredible incentive model around linking bonuses to impact. And there are a couple of other funds that do that as well. And I think the main challenge really around the space is LPs being more demanding of their fund managers and fund managers being more imaginative and more demanding of themselves.
Oh, could you maybe like elaborate a bit more? That's a very interesting
Well,
perspective.
just be more imaginative. Like, imagine a better future. Like I don't think we need to have another vape pen. I just like there are all these things that people get super excited about that hit my inbox sometimes, and I'm like, just why? You are so talented, you are so bright, and you've really over fixated on this thing that's totally irrelevant. So anyway.
That's very interesting insight. Yeah, you're right. I guess I'm also curious about Kalytix Ventures because you started it and you're solo GP if I'm not mistaken. And I'm assuming it comes with a degree of autonomy, but also degree of kind of pressure, which perhaps you like and you're used to by now. I guess what are the unique and advantages and challenges of operating as a solo investor?
Yeah, so with Kalytix Ventures, it's kind of a venture platform. It's not quite a fund, but I've done a series of SPVs, and otherwise, I've managed family money in direct investments and in fund investments. I think in general, I think that a solo GP firm is a bit of a myth.
Mm-hmm.
It was interesting. I was just talking with one of my investors who's part of a really large university endowment. He's like the CEO of it. And he was saying, well, what do you mean by that? And I'm like, well, solo GPs typically rely on a team around them to make it happen. And selecting investments is only one part of the function of a VC. You also have to fundraise and manage LPs, report, and you also have to source deals or become the lighthouse for deals. And that takes quite a lot of effort. So what I do notice in the solo GP landscape is you've got very particular type of archetypes. You've got some people who had a lot of money and can build teams around them and still not need to, I guess, share the GP carry. Those people tend to have more wealth, I guess. Then you've got people like super scrappy, and are doing small checks, who are like, have got all of the apps. They've got Barter on their phone, or they've got Brex on their phone. They're just trying to make it happen. But I think that's a pretty like lonely road to walk. And then in terms of, if you look at some of the best venture capital firms, you notice that only one or two GPs often produce the returns for the firm. But I think there's this misperception that would have been able to do that without the infrastructure. So I think it's a bit of a fantasy. I think the solo GP idea I think it is a bit of a fantasy because I don't think without all of that supportive team and infrastructure, you can actually find and execute good investments. So I'm less keen about solo GP, even though I've been doing it. I also think it's like personally, it takes over your life because you're so self-reliant. And I'd say that when things are going really well, nobody wants to hear it. Nobody wants to hear it. Nobody really wants to hear it. And when things are going poorly, some people want to hear it, but probably for the wrong reasons. And so, I'm really leaning back into teams. So as my company evolves, I'm really thinking about adding people versus remaining like a lone wolf.
Oh wow, that's a very unique kind of perspective. That's really cool. And one thing I'm curious about is that such an extensive experience in the space, and you've been exposed to so many different founders and startups. Besides the impact, underlying impact kind of philosophy, what makes a Kalytix investment? What makes an investment for you kind of like a yes decision, right? Are there any traits you consistently look for across all companies, regardless of sector you invest in?
I always like to see like the set of cards that have been delivered through a pitch. I'm also a venture partner at Social Impact Capital, and I'm also an IC member, and I vote at Conduit Connect in London. So I'm constantly looking at companies monthly and signing off on them. It's always really interesting to see what everyone's leading with. You're kind of almost grading the founding team that you meet. I generally get really excited about breakthrough technologies, structural impact plays. So, people are taking on really massive issues with either software or hardware or whatever it is. I'm actually technology agnostic often as well. I'm less like wedded to more interested in the challenge than I am in the technology. But obviously, the technology is really important because you want to know if it actually works. I'd say like statistically significant. I go back to that often over and over and over again. I think, how do you figure in the grand challenge that you're trying to tackle? And then also diversity of team. I'm always like, who does what? what are the secret sources of those people, and how does it all meld and mesh together?
I see. This common notion that it's better to have A team with a B ideas than B team with an A idea. Do you agree with that, or do you think?
That sounds like, I don't know, it's like fortune cookie wisdom, isn't it? It's like
Fair enough.
really reductive, isn't it?
Yeah, fair enough. I guess as a follow-up question, you've invested, and you said you're kind of technology agnostic, but you're more focused on the challenge. But you've invested in health tech, climate tech, marketplaces, which can be quite different in terms of technologies and an underlying kind of like the science behind it, and they can be quite complex and quite different from each other, right? What how do you approach investing in such different kind of technologies, challenges? Not only look at the technology, but also understand the challenge enough to be like, okay, I actually believe in this idea, I believe in this technology enough to invest in, and how they kind of come together, tie together.
Yeah. So, I mean, how I would answer that really is taking a step back. So, I invest in resiliency, adaptation, and survival as like more existential thematics. But then underneath that, that involves health, environment, and economic empowerment as thematics. Obviously, that cuts across geographies. But I think the really important thing to know and to always remind yourself is that we are all interconnected, we're all interdependent. And, I think that when you are thinking about some of these grand challenges, you suddenly realize when you're really doing a lot of the research that in order to fix a particular problem, you have to look at all of the chain of effects and keep looking at that chain. It's basically infinite, really, and circular ultimately when you look at the chain. And in terms of complexity of being able to pass deals technologically, if I'm looking like a deep tech investment or a biotech investment or a deep science investment, typically I'm looking about who has produced the technology, what papers are produced. You get advisors to help diligence the tech. The challenges at the early stage is often the diligence around technology is super divided. And it's really
Yeah.
interesting sometimes around who says what and what stage of career they're at in terms of technological viability. So there is a bit of like a leap of faith you need to do. And often it's, if this works and if this is true, then this is game changing, right? A pre-seed, that's the leap of faith you need to make. And you can diligence that. I think that when you're operating in regions that are outside of your country, it's really valuable having local syndicate partners who you trust. It's also really important to get to know founders over time, where they're from and what their stories are. I think I really love in non-OECD countries investing in founders who have gone back, having been internationally educated, to set up something in their own country. I really love those founders a lot because they're so aligned with what they're building. So yeah, I mean, the other thing is like, there's no excuse these days for not going deep into things. We've got the technologies to be able to do it. We've got AI, right? Like, sure, some of the information you get back is inaccurate, but you can verify what you're learning. And I wouldn't say any of these sectors are hermetically sealed.
Interesting. And you know, and this is probably is not valid really anymore. But before some of these things, I would read, be like, it's not really possible to have both impact and the financial returns, right? Which is obviously kind of like a misconception and a myth. I guess I'm curious, in your portfolio companies, which company do you think best represents this kind of thesis around building resilient systems that create both financial and social value?
Yeah, so companies I'm really excited about really vary. If we're going to talk more on like the soft side of impact, which is, I'd say, around social or economic empowerment type investments. I've got a couple of companies in the global south that I'm really excited about. I think that, just to take a step back again, what I'm really excited about in more developed markets with venture capital is more advanced technology breakthroughs. I think we've got some amazing university systems in Europe and America and China and Southeast Asia to some degree. And I think the trend that we're going to see is a continuation of amazing breakthroughs. And I really want to be part of those for like climate or water or whatever it is. I think that there's also a trend that's happening right now, which is growth of population and middle classes in the global south. So think of that as LATAM, Sub-Saharan Africa, Southeast Asia, Eastern Europe as well. India is actually booming at the moment in terms of deal volume. And there are needs. There are energy needs and there's infrastructure needs that I think sometimes we take for granted. So to give you an example of that, one of my investments is called Lamy. It's based in Kenya. And what they basically do is fill the gap of insurance in the continent. So there's only 3% insurance penetration across all of the African continent. And there's been no method, or they haven't had the infrastructure to develop these kinds of insurance products. And so what Lamy does is basically create this interface and data flows and infrastructure to be able to develop insurance products across any sector that you might want to develop one in your country. So they want to expand across Nigeria and other countries, and they're doing incredibly well. And, insurance products for average people and, growing middle classes, you have it for your house, you have it for your phone, you have it for your health in many OECD countries. And I think that's a real play towards resilience, or like social resilience within these different countries. Another one I would talk about is Plena. Plena is based in Mexico, but also wants to expand to Colombia and different parts of Latin America. Again, huge growing populations. Again, those countries are experiencing like vast volume increases in deal flow. And what they do basically is create a vetted platform for women's health management. So it's kind of like a combination of technology play as well as clinics that focus on menstruation to menopause for women across Latin America. And there's a massive demand for it and shortage of vetted vendors for this kind of thing. And actually, it's a big problem in these sorts of countries. And yeah, so I'm just like really excited about that as well, because, if you want to fix climate change, for instance, if you really look at all the different details, you also have to empower women as well. So that's kind of like the interconnectivity thought that I have. And then another is like photomarine. They're electrifying marine fleet for sustainable oceans. And then more recently, I did an investment in OptiCloud. As you know, like there's a lot more like data infrastructure being built now to accommodate AI. Obviously, massive tech companies have incredible compute use. And in the same way that we've thought about waste management, we're now in an era of now thinking about compute waste management or digital waste management. And this company's basically figured out a way to look across all of the tech stacks of these sorts of companies with agentic AI and identify all of the wastage within those companies. And they're already working with these amazing Fortune 500 companies to do that. And so, if you can lower compute, you lower infrastructure needs and thereby you lower emissions. So I'm quite excited about that too.
All of them are very cool companies. Some of them quite deep techy, and as they'll require a lot of capital, I'm assuming. And we touched upon it already, but I still want to kind of get maybe something, you have something else to say about that too, because I feel like one of the criticisms about deep tech investment, especially in Europe a bit, is about sometimes investors look at it with like a software investment mindset, and the timelines are like not very much, because deep tech is very capital intensive. The return on investment takes a while. Do you think like to sustain these startups, to sustain these impactful long-term innovations, what needs to change in the broader venture ecosystem to ensure that the capital continues to flow into them?
Well, it's interesting with deep tech investing, and I think a really great person to follow on this is Ian Roundtree at Cantos, an LP in that fund, and I really love what he does. And he
Very
shows
cool fund.
examples of companies that are doing deep tech or hard tech innovation who are demonstrating low capex and overhead in building what they're building. And there's this whole trend towards like low capex modular infrastructure that's evolving, where it's actually less capital intensive than you think. But obviously it varies and it really depends, because like biotech is completely different in that regard. So again, like I think the challenge often with deep tech investing is like big generalizations around the space, because you always find these edge cases, and those are the most exciting things to invest in. I think, the other challenge is how you respond to failures. Obviously, there was the failure of Northvolt, right? And that might put people off of doing batteries, or, whatever sector it is or whatever innovation it is. But failure is part of the venture capital game. Like, if you look at the statistics, basically 80 to 90% of your portfolio dies over the course of the term of the fund. And so, of course, there's going to be examples around failures. I also think that, the challenges sometimes around deep tech come towards like the commercial cycles. So regulatory environments, selling into municipalities, those sorts of things, like longer sales cycles. But there's appetite for it. And in fact, if you look at the real asset market, we look at some of these massive asset managers, UBS is a really good example, Blackstone, etc. Like, a lot of people are there for the growth financing for these kinds of innovations. And there is oftentimes, at least within climate, for deep tech investing, an economic imperative to be funding these solutions. I think there's challenges around early stage pipeline, I think, for some certain areas. I was just interviewed by a lady who is at Digital Frontier about water investing. And there's like a massive water gap, even though the risks associated with water versus carbon emissions are 3 times greater, according to Barclays. It's interesting. I think behaviorally, why you don't see as many venture capitalists maybe doing deep tech investing is that there are fewer proof points. For instance, water's, again, a really good example. There's only really one unicorn, Gradient, who is an example of something that's a success in that area. And so, it's also technical and complicated, and, it's sometimes easier to invest in SaaS software. So there's that too. And then I think that, VCs tend to be trend animals, and they jump on the carousel of the next thing. So, at the moment it's AI. Before that, it was blockchain. Then they revert back to what they did before. So, well, then it's defense tech, whatever it is, right? And so I think people sticking the course and sticking to their guns of the thesis that you hopefully think they have about the world, and not doing these sort of like quarterly jumps to whatever is fashionable and then kind of shoehorning it in relation to your mandate.
You actually mentioned something I was going to ask, so thank you for that segue. The thing about hype is very human psychology. We like trends. We like, following the hype. And VC is no different. There are hype cycles. There was clean tech hype cycle. Some time ago, there was blockchain, as you said. Now it's AI. 2020 pandemics, mRNA technologies, therapies, or the focus area. How do you prevent yourself from kind of like falling into that hype and looking at technologies as objectively as possible without not really being affected by this FOMO, fear of missing out, right?
One good rule of thumb is if you have nothing and out the door you're raising at an insane valuation, don't invest in it. Be diligent with yourself. Like pre-seed, like I love sub 10, even 4 million valuations, low valuations. For companies that lead with a really strong hand, you really have to take a leap of faith with that founder, not to be more of an incrementalist and follow the like traditional pre-seed, seed, series A route. This sort of napkin big idea investing, and you raise 2 billion, seems like you've just got a bunch of people with way too much money throwing blocks of, $100 bills with big bonfires. And yeah, I think that also, I think that's how you I guess that's how you avoid the hype, right? Like you just take a step back and you're like, is this sensible? Would I do this with any other company? And why? I don't believe in brand names at the early stage. I think it's like totally irrelevant. I don't think it's a signal that you might have a very flashy venture firm or even set of venture firms at the pre-seed investing on something, mainly because of like their attention span when you're managing multi-billion-dollar funds, as a venture firm. So I'm less interested in signal. I think like you do your own research, you talk to people who are in the know, who might be like lesser known and like less popular, to determine whether or not you should be investing in something. That's my general like rules of thumb.
One thing I'm curious about is, and with the rise of AI, as you said, the valuations have increased like insanely, especially like early stage valuations sound like growth stage investments. And there's also, I was talking to this one biotech investor, and she was mentioning about how like even in tech biospace, there's a bit of a feeling that you throw money and you're just hoping that the company will figure out the commercialization later on. They don't really know how they're going to sell it, but they're hoping that something's going to come, and until then, let's just throw money in it. How do you clarify what's the strategy? Like, how do you want to commercialize this? But what's your take on it? What's your approach to that?
It's interesting. I was talking to one of the GPs at Science Creates Ventures. They're based in Bristol and London, but they invest internationally and nationally. They focus on deep tech investments. And John was the founder of Kudan, and he was one of the first people to develop artificial perception and ended up being the back end for some major companies around the world, and then I think listed on the Tokyo Stock Exchange. And it's quite interesting. His story was at the very early stage, if he had followed VC's advice, he wouldn't actually have a business because, everyone and their mum is trying to get you to anchor down on what you should be doing with this technology and how it should be applied and what the strategy is. And honestly, for like 2 years, he played around with that technology in different contexts, actually followed like a consulting model for a while, and then played around to try and find product market fit versus trying to shoehorn it into a certain market out the door. I think with early innovation and early breakthroughs in tech, being open to the pivot around not just who you're selling into, but what you're doing with the technology is really important. And it's actually to your detriment if you've got overbearing board members or venture capitalists who have got like some really staunch view about what you should be doing with it. So you sort of need to have that flexibility at the early stage. And it kind of goes back to what I was saying around the reality creation asset class idea. So I think with company formation, it's quite interesting because you have like a thesis about the world, and that's why you're building this tech. And then you're assuming that the market will want this thing. But what's quite interesting is you go into the market and then it's kind of like a confrontation with reality. And it's not to mean to say that you get it perfect, as in like in terms of your business and your thesis being entirely correct about what the market wants. It's about kind of like how parallel are you to that line of whether or not you'll be successful. And you have to allow for the undulation of your attempts to get close to where the market is and what the market wants. So again, early stage, you do need to have that flexibility.
Gotcha. We talked about technology. We talked about the business models and the investments and everything. One thing I'm curious about is, and I feel like I pretty much see it every day on LinkedIn, is about this founder archetypes, this obsessed, unhinged founders that works 23 hours a day, and that's gonna build a decacorn and a unicorn, and etc. What kind of qualities do you look for in the founders? What's your take on that?
Well, again, it's like it's broad sweeping statements that I try to avoid because everything is specific. There are specificities around people, and there's also so much that you can't control. So it really depends on the circumstance, I think. I feel like advice like that is like the equivalent of a lot of the, horoscope accounts I follow on Instagram, like the same sort of like, it's not particularly useful advice, I think. Of course you want to have somebody who's obsessed with what they're doing who every day is going to get up and work on that problem really efficiently and smartly, not necessarily hard, right? If you've got somebody who's like really obsessed about the thing and then they end up burning themselves out, then they'll end up making really poor decisions. So I'm not sure. I really don't appreciate like hustle culture in venture capital in an extent where it's become hyper hustle culture. It's not even just about like, trying to make things happen. It's about like exploiting yourself. I don't really think that makes for very healthy work environments or healthy outcomes for businesses over time.
Got it. Very, very, very nice insight. You invest in so many different geographies, and I know you don't like the term emerging markets, which we'll talk about soon. What regions or markets do you think are currently overlooked in the venture landscape, and why?
It was quite interesting. So I was doing this research. I've got this other podcast coming up in a couple of weeks, which is kind of about tariffs and trade relationships and that sort of thing. I was going through deal volume in global venture in the historical markets as well as markets outside of the hubs in the US, UK, China, Europe, etc. And what you're basically seeing quarter on quarter is decline of deal volume. In the States, if you remove Anthropic and a bunch of AI companies, for 4 quarters, deal volume and venture has declined if you just take out the big hype deals. That decline is experienced also in the UK and China, Europe as well. But conversely, some countries in areas like LATAM, Southeast Asia, Sub-Saharan Africa, Eastern Europe, some of these countries have experienced continued and persistent deal volume growth despite the sort of market downturn. India is a really good example of that. India is booming now in terms of early stage, but also now growth stage investing. That's an area I'm quite excited about in terms of population growth, cost of living, people being able to launch their companies and get them up into the cloud and like use digital infrastructure and that kind of thing. I think there are many, many opportunities. It's huge population, which the GDP will eventually exceed America's. I think that's particularly exciting. Mentioned Mexico and Colombia also have some really good macros. Eastern Europe, Poland, clearly Lithuania, Estonia, stuff like that. And Southeast Asia is huge. Like energy demand since the 2000s has increased fivefold. So, Asia, Malaysia, that whole area, again, insane population growth. So I really like those sorts of trends. And you're right, like I don't talk about them in terms of emerging markets because I think it's a pretty anachronistic and outdated term. If you look at real asset investors, some of them describe them as big middle income countries. So it's basically countries that have grown quite rapidly that have now booming middle class. That's actually very attractive for venture capital investment, those sorts of dynamics. What I'm also quite interested in is how the OECD countries with their advanced technological hubs of innovation and talent might sell into those regions as well. I'm quite excited about that as a theme. And I'm also talking to entrepreneurs who have that as part of their business model. Like I find that quite exciting.
Got it. And you did say that you don't like calling them emerging markets, so I'm not going to call them emerging markets, but I am. Some of them are still relatively sort of recent and younger VC ecosystems, startup ecosystems that are still developing. And early stage investment is already very risky everywhere, but I feel like taking that into consideration becomes even riskier, right? So how do you manage that? How do you assess and manage that risk when you do investments in those regions?
Yeah, so I've described these economies as growth economies, but it really depends on the country. It's not like blanket. You can't just say Africa because Africa's humongous and a continent, right? So you have to get really specific. If you look at all the fundamentals, like, again, this is why I go to macros and I'm quite thankful that I've got this kind of background because you look at the debt to GDP ratios, you look at energy consumption, you look at all of these fundamentals, you look at stability, you can look at political stability, but if you look at what's happening right now, there's actually quite a lot of political instability in the West, right? So I just think that, given what's happening and has happened for decades in this sort of slight imperialism or continuation really of imperialism in these regions. I think this framework around risk is much more loaded and problematic than we would like to think about it. And I actually think it's really a problem for us. I think we don't realize that we're kind of shooting ourselves in the foot by having this bias or perception that because you're doing business in a country with people who don't look like you, who have got wealth relatively recently, that they're somehow riskier to do business with. If you then, of course, factor in like governance and stability and those sorts of things.
That's very fair point. Very fair point. One thing you mentioned about energy consumptions that really remind me of something is that I feel like the rise of AI has changed a lot of equations in a ways that, I mean, it is causing problems in terms of like the water usage, in terms of like how much energy is being consumed for that. But it's also it's at least being kind of presented as the tool that's going to solve a lot of things, a lot of our issues, a lot of our problems. How do you see AI kind of playing in the future of venture capital and startup innovation, especially as the world, as we see it today, faces increasingly complex societal and environmental challenges?
Sorry, could you reframe that question?
So I kind of rambled and I was all over the place, but what I'm trying to say is, AI is kind of this double-edged sword, right? Right now we are seeing a lot of, energy consumption with AI, a lot of water usage with AI. So a lot of problematic things that's actually like impacting our environment. On the other hand, people are saying how AI is going to solve a lot of our issues, whether it's societal issues, whether it's environmental issues, whether it's energy issues. And I'm like, what's your take on that? Like, how do you use it? How do you view AI affecting kind of everything as we move forward into the future?
Yeah, so I think it's an amazing tool for augmenting decision making, particularly under uncertainty, but also when you're ignorant or like don't know things, right? And all of us don't know much, right? So it's really handy to have that kind of tool. It's important to understand it as a tool and not perfect either. And I'm quite excited in terms of it being able to elevate our intelligence hypothetically. Of course, there are studies around retention and using AI, which have come out recently out of MIT, which are really depressing. And of course, people becoming mentally unwell or psychotic by using the ChatGPT. So of course, there's those instances. But also when you think about AI as applied to, tech breakthroughs, hardware, science breakthroughs, like I think that accelerates the rate of discovery, which I'm quite excited about. Of course, you touched on the carbon emissions and the water scarcity issues, which basically, intensifies some of these macros. And so it should, in my opinion, be both up to the government and asset managers and LPs to demand parameters around how you're doing business if you're building these sorts of companies, and the supply chain around you as well. I'm not like a absolutist when it comes to neoliberal and capitalist like market forces. I don't think that the market is rational by any means. So I think it's really important that business leaders lead by example in this area, and that policy is developed that is actually meaningful and intelligent with what's going on.
We are coming towards the end of our episode, so I'm going to just ask you two questions. It's been a very informative episode. I really appreciate your time and your insights. I think one thing I'm curious about is, as a VC, not only you have to assess the trends that are happening, but sometimes you have to predict them before they even happen. And you look into macro factors a lot, and you look into space a lot too. I guess for in the next 5 to 10 years, what kind of technologies you are most excited about, or you want to see to come into existence?
So there are lots, right? And you know what my thematics are, but basically I'm attracted to any technology that creates hyper efficiency and kind of totally new modes of producing critical resources, using what has been historically known as like externalities, so atmospheric carbon, for example, for new purposes. I'm also quite interested in completely new energy sources, as well as solutions to build capacity sustainably, really. And then I guess the other areas of interest is we're going to have some really big challenges around food availability and water scarcity. So those are other parts of the investing market that I'm quite excited about.
Got it. And now, and I guess final question, if is there going to be people, I guess younger people like myself watching this and as they're hoping to be investors or entrepreneurs or both of them at some point, what advice would you give to them if they're wanting to make a difference through their work?
Yeah, like hold on to that passion. Don't let people kick you about and compromise on what you believe and what you think is important. I think you need to defend that. It's not even just for yourself; it's also for everyone around you as well, because it's their benefit that you care. So, I think your intention and if your spirit is in the right place, you just need to keep proving it, use the data and quantify it a lot because that's what speaks in business is all the numbers. So, just be prepared to, prove your homework, I guess, and also be persuasive. So, Warren Buffett talks about one of the number one skills in this era of AI being public speaking skills, convincing people that the reason you care matters is really, really important. So just stick up for yourself.
Great. This was a wonderful episode. Genuinely, I feel like I have to watch it again to just take some notes to remember a few insights and points you made. I really appreciate your time and all the insights. And thanks so much.
Thank you so much for having me.